Great. Welcome, everybody. My name is Doug Pless. I'm a pro trader and educator, SpotGamma content contributor, and also a Bookmap Academy member. So this is one of the case studies that I presented, one of the 6 case studies that I presented at boot camp in December. And Matt asked me to present this to all SpotGamma subscribers. And the case studies showed how to use a variety of SpotGamma tools to find, plan, and execute trades in ETFs, stocks, and futures. So this case study for today is QQQ, and that is the ETF that tracks the NASDAQ 100. And I have a 2-step process for trading: planning and execution. And planning is based on positional analysis. And I look at how traders and market makers are positioned in the options market and how those positions change from day to day to develop a thesis regarding volatility and expected trading range for the day and a directional bias. And this is, I think, a new way of looking at the market. A lot of traders use technical analysis or fundamental analysis. And again, I use positional analysis, a new way of looking at the market that I think provides a significant edge. And then execution is based on price action, and I look at how price reacts at key gamma levels, as well as real-time order flow. So in this workshop today, in this case study, we're going to look at how I use this process to get from planning to execution for QQQ. And what I want to talk about today is first go over a brief overview of ETF, the QQQ, what it is, what are the holdings, what it represents, and why you might want to trade it. And then I'll talk about my planning process and how to use positional analysis, the key metrics, and the graphs that SpotGamma provides to develop a thesis for the day. And then we'll pause for questions and answers. And of course, questions are welcome at any time. And then I'll talk about trade execution. So how I took that information that I developed, the thesis that I developed during the planning process to actually help me execute a trade in QQQ. And then finally, we'll take a look at some alternative trades, primarily using options. And again, remember, questions are welcome at any time. So QQQ is an exchange traded fund that tracks the NASDAQ 100 index. And the index includes the 100 largest non-financial companies listed on the NASDAQ based on market cap. And the top 10 holdings include some very familiar names: Apple, Microsoft, Amazon, Tesla, Google, NVIDIA, Meta, and those stocks all have very active options that trade daily. And those are stocks that I trade on a regular basis. And along with QQQ, again, all QQQ as well as all these stocks have very active options markets. And the price action of these stocks and QQQ responds very well to options trades and market maker hedging activity. Now, for my planning process, I looked at all this data that, again, is available to all subscribers. And first, positional analysis. I look at key gamma levels, and that is the volatility trigger, the absolute gamma strike, put wall, and call wall. I also look at additional key metrics that provide information that shows how traders and market makers are positioned. So this is just additional information that's showing, again, how traders and market makers are positioned. And this is only some of the data that's available. This is what I focus on and what I'm focusing on for this presentation, but SpotGamma provides a lot of additional information. And for graphical view, I look at graphs that show the key gamma levels and how gamma and vanna change with price, volatility, and time. And that's the SpotGamma levels charts and the vanna model. And before discussing this case study, what I want to do is look at some background information and definitions of these levels and metrics, just to make sure everyone is on the same page. So first of all, the volatility trigger, and that is SpotGamma's proprietary gamma flip level with positive gamma above and negative gamma below. So what SpotGamma does for an index like QQQ, SPX, and SPY, SpotGamma assumes that traders are long puts and short calls, and market makers take the opposite side of that position. So SpotGamma assumes that market makers are short puts and long calls. So with positive gamma above the volatility trigger, that is in the positive portion of the gamma curve. So again, market makers assume that SpotGamma assumes that market makers are long calls, so that's positive gamma. And then when price is above that level, market makers will need to hedge opposite the direction of price. So as price increases, remember they're long calls, so they have to sell the underlying or sell futures. Potentially in the case of QQQ, they might be selling QQQ or NQ futures to hedge their delta exposure. And then they can buy back the underlying QQQ or NQ as price decreases. So that is a positive gamma environment. And that has been pretty rare in the last year. And then on the other hand, below the gamma flip level, the volatility trigger, SpotGamma assumes that market makers are short puts. So that is in a negative gamma environment, and they have to sell futures as price, or sell QQQ or futures as price decreases, and they can buy back the underlying or futures as price increases. So above the gamma flip level volatility trigger, market makers hedging activity tends to suppress volatility since they're trading against price, and below that level, it tends to enhance volatility since they're trading with price. The next level that I look at is the SpotGamma absolute gamma strike, and that is the strike with the largest total gamma position. And a large amount of market makers' hedging position may be tied to this level, and it can often act as supported resistance. And the next level is the put wall, and that's the strike with the largest net negative gamma, and it can act as support. And a change in the put wall level can be an indication of shifts in large put positions, and a shift higher is often a bullish signal. And then the call wall is the strike with the largest net positive gamma, and it can act as resistance, since market makers will most likely have to increase delta hedging at that level. And it can also indicate traders' expectations for the upper end of price movement, and a shift higher is often a bullish signal, and a shift lower can be a bearish signal. So one thing that I want to look at is, let's just take a look at the absolute gamma levels for QQQ today, just to give an idea of what I'm looking at. So this is QQQ, the absolute gamma levels. This is for today. Remember, we're looking at a trade study from last year, but this is today, just to give you an idea of how this sets up. So for today, this is the 280 level, and that is the absolute gamma strike for QQQ today. And then this is the call wall at the 290 level. Again, the strike with the largest net positive gamma. And then the put wall at the 270 level. And that is the the level with the largest net negative gamma. And what this graph is showing is put gamma or negative gamma below the 0 line. And that's shown with the teal color, and positive gamma or call gamma above the line. So again, this is just for today, just to give a visual example of these levels. So for today, put wall, absolute gamma strike, and call wall at 270, 280, and 290. Okay, the key metrics that I look at, again, and this is just some of the information that is available to subscribers. First of all, the CP gamma tilt, and that's the ratio of total call gamma to total put gamma. It's very similar to a standard put call ratio. However, SpotGamma applies a gamma weighting to the ratio. An increase in this CP gamma tilt is considered a bullish signal, and a decrease a bearish signal. And gamma notional, I think this is very important. I look at this every day, and it's the sum of market maker call gamma minus the sum of put gamma. And again, referring back to the discussion of the volatility trigger, positive gamma position indicates infers lower volatility in the underlying, since market makers will need to trade against price to hedge their delta exposure. And a negative gamma position implies higher volatility in the underlying, since market makers will need to hedge with the delta exposure. So it's very important to understand how market makers are positioned on the gamma curve to anticipate how they may react, especially with big events like economic data coming out like CPI or FOMC announcements, or even expirations. And for the graphical view, the charts that I look at, first of all, the SpotGamma levels chart, and that's available on the founders notes, the AM and PM founders notes. And these charts show how gamma changes at different price levels. And estimated gamma for calls is shown as positive, and gamma for puts is negative. And the chart also shows all the key gamma levels. And then the Vanna model, that chart shows how market maker delta exposure may shift as price and implied volatility move up and down. And we'll look at these, all of these in this example. So again, showing how market maker delta exposure may shift as price and implied volatility move up or down. And that's shown by the green line for the current expiration. And the slope of the line shows or indicates how aggressively market makers may have to buy or sell the underlying to hedge their delta exposure as price and implied volatility change. And again, that's the green line. And the model also adjusts for time by showing how hedging requirements may change after the next expiration. And that's the black line. So the green line is showing the Vanna effect, essentially. That's a change in delta with a change in implied volatility. And the black line is showing the charm effect, how delta changes as time passes. Okay, so that's the background information. Again, just wanted to make sure that everybody was on the same page with this information. So now let's get into the actual example. So this is for QQQ last year on August 15th. So what this slide is doing is comparing the levels and metrics that I talked about, the four key gamma levels, as well as the CP gamma tilt and gamma notional for August 12th, that's the previous day, and that's a Friday, versus the day of the trade, and that's Monday, August 15th. So I'm showing the changes in levels, and I'm color coding the numbers based on whether the number increased or decreased. So this chart is showing from August 12th to the 15th that the volatility trigger dropped 1 point to 322, and the absolute gamma strike increased from 325 to 330. The put wall dropped from 320 to 300, and the call wall increased from 330 to 335. And also the CP gamma tilt became more positive, and gamma notional shifted from negative 236 to about positive 23. And again, this is one of the rare instances where gamma notional has been positive in the last year. And this shows where the data came from. And this is for the 12th, August 12th, the spot gamma levels charts. And again, showing positive gamma above zero line, or call gamma above this line, and negative gamma or put gamma below the line. And it's also showing all the key levels. So this is where the data comes from that I had in the showed in the charts above. So that's the 12th. And this shows the shifts in levels on Monday, August 15th. Okay, this is the Vanna model. And here, this is for August 15th. And the way to interpret this, I usually just draw a line. I'm just using a pen drawing tool here and draw a line through this Vanna model that makes sense. So what this is showing is, again, how market makers' delta notional or delta exposure will change with shifts in price, and that's shown by the horizontal axis, and also with changes in implied volatility, and that's shown by the green line. So what this is showing is a very neutral Vanna model, showing no significant skew in delta notional as price increases or decreases, and indicating that market makers would have very little need to hedge delta exposure as price moves up and down in the range shown on the chart. And again, the black line shows the next expiration, and that takes into account charm and showing how their market makers' delta notional will change as time passes. Okay, let's pause for questions here. So does anyone have any questions? What's your thesis? How would you interpret the data? And what would you do? Brett, any questions or comments?
Sorry about that. sitting here talking, saying the most intelligent things ever on mute. Yeah, so if y'all have any questions or you want to answer or bring up, kind of give your forecast here, you want to raise your hand or just pop it in the chat box, the Q&A box. I'll be happy to read that off. But basically, when you see all these levels move in conjunction with each other, to me, those are when the signals really seem to line up the strongest. And so what all this is really pretending is the shift of options positions higher or lower is telling us that the options market is resetting to new price action, right? So like, for instance, if we see all the levels rolling higher, oftentimes it signals that the options market's accepting those higher levels or those relatively lower levels. So Enho asks here, do you mainly day trade with this data? And I think, Doug, you typically have just a one day trading window, right?
Yeah, that's correct. I think for right now, the way I look at this, I think provides me with a great edge for day trades. And I have not, I know Brent takes a maybe a longer time frame look, more of a macro view for position, maybe position trades or swing trades. The way I look at this and the way I interpret the data, I think gives me the greatest edge for day trades. And I reassess every morning. So I do go through my planning process every morning for day trades. And that's the way I'm approaching it right now.
Yeah, I think that makes sense. I mean, to each to each his own. From these respects, I generally have pretty short term views, but I will actually allocate. When I have my 401k, for example, or my retirement funds, I will allocate into and out of equities on a weekly basis or something like that based on a lot of these levels. So, particularly, for example, if we see the market careening into a big expiration where I know a lot of puts are going to expire, right? I'm happy to maybe buy that level and let that work for a little bit. So there's a bunch of different ways or views that you could play here accordingly off these levels. So it's not necessarily a one-trick pony. We also have a lot of people who like to sell options around these levels. Other people like yourself, Doug, may just buy the future, buy the Qs themselves to express your long or short view. So there's a lot of different ways that you can kind of try to attack try to express, I should say, your view.
I think especially with the 0 DTE options now, trading at a very short time frame has, just really gained in popularity, and those, that's a lot of what I'm doing now is looking at the 0 DTE options, and I'm so busy. My schedule is so busy. I'm doing 2 presentations today. It's instead of just looking at a chart and trying to perfectly time an entry, I just can buy or sell an option based on my view for the day and let it work. But again, my time frame is 1 day.
Yeah, you bring up a great point there. I mean, sometimes the 0 DTs are so cheap that you say, well, I'm willing to take a 5-point stop on an E-mini contract, or I could just buy the 0 DT call for $3, and the risk reward is much arguably much better. So you do bring up a very interesting point in that regards.
So for example, yesterday I thought the trade of the day was buying a put in SPY as the SPY 400 call wall acted as resistance. And that was a great trade. You could have, I can't recall exactly what the at the money 0 DTE SPY calls were trading for yesterday, probably around $1. And I think you could have made at the end of the day that at the money call that you bought around 400 was up about to $6, something like that. So that was the trade of the day yesterday.
Yeah, there are a tremendous amount of opportunities kind of embedded in there. So let's step forward here and see how the trade actually worked out.
Okay, so let's see. Gregory asked, we're focusing on a This is an older trade. This is something that I presented at boot camp in December, and this is from August 15th.
Mm-hmm.
And there's a question about the current order book, and I'll talk about that. I use Bookmap, and that does show the current order book. And I'll show how I use Bookmap to enter a trade based on my planning process. So here's the thesis that I developed from the data. First of all, I anticipated low volatility. And the reasons were, first of all, gamma notional shifted from negative to slightly positive. Again, that's pretty rare for QQQ in the last year. And again, meaning that market makers' gamma position was positive, and they would need to hedge against price to hedge their delta exposure. Also, the neutral Vanna model showed that, and also showed that market maker hedging activity would most likely not be a significant factor for the day. And then QQQ was trading well above the volatility trigger, again indicating market makers most likely have a positive gamma position. And this is often a bullish signal when the instrument you're trading is trading above the volatility trigger. It's typically a good idea to lean bullish. And then my directional bias was bullish. And I looked at the rising absolute gamma strike, indicating traders' expectations for higher prices. Also, the rising call wall, again indicating traders' expectations for a higher upper end of price movement. And also the rising CP gamma tilt, indicating call positions were increasing relative to put positions. And again, QQQ trading above the volatility trigger. So bottom line, I was looking for a lower volatility day and also looking for bullish entries. So here's the trade execution. And again, I use Bookmap. And this is showing order flow. It's a little bit different from candlestick charts. This is showing there's a question about the current order book. That's in this column here. This is showing the limit buy and sell orders in the order book. And the heat map is showing a history of those orders. For example, these lines here, the darker levels are showing a history of these sell orders. And the green and pink dots are showing market buy and sell orders. And a green dot shows market buys, but they're all showing market buy minus market sell. And a green dot means there are more market buy orders than sell orders, and the opposite for a pink dot, more sell orders than buy orders. And also I'm showing on my charts, and this is something that I do every day for all these stocks that I follow, is I mark all of these levels. I use my own cloud notes to show the yellow is just showing the round number levels, and then the white is showing the key SpotGamma levels. So this 330 level is the absolute gamma strike or the key gamma strike. And that's what this is showing right here. And I pay close attention to these levels, and that's shown by this white line. So in this example, after the open, QQQ moved up and down in a range for almost 2 hours, and it was really focused around the 330 absolute gamma strike. And this is a session volume profile showing all the volume concentrated at that area, really between the 331 level and the 330. So showing how important that 330 level was. And around 11:15 a.m. Eastern time, QQQ tested the 330 level for the last time, and I was expecting this level to act as support, and it did. And there are a couple of ways of looking at this for an entry. You could look at this trend break, or just the final test of the 330 level, and notice here these green dots coming in, and these little small numbers are showing that buyers are absorbing sellers. So I'm using a combination of SpotGamma levels and order flow to help confirm my thesis. Again, remember, I'm looking for bullish entries. So I'm waiting, and looking at the final test of this level, trend break, and then looking for a bullish entry. So these numbers here showing kind of a step-by-step sequence. First showing the buyers absorbing sellers, that number 1, and 3 is where the aggressive buyers start coming in. And this number 2 here, that's showing this blue line is showing the positive cumulative delta. And that's bullish, showing that traders are starting to buy. So 3 really would have been the first good entry. Trend break, aggressive buyers coming in. And again, remember, I was also looking for a lower volatility day. So this is not a lot of movement. And there were targets. I was looking at targets at the 332 level, the 333, and the 334. And then notice the quick move up after the trend break. And then a lot of consolidation around for almost 3 hours. And then a final move higher around 2:30 Eastern time, up and didn't quite make it to the 334, and the liquidity up here at that level. And that liquidity often acts as price targets. So it looks like there are a couple questions.
Yeah, the initial one was the COB, and then the second one is, how do you get the volume levels on the chart that you're pointing at? That's a feature of Bookmap, right?
Let's see, are you talking about the volume profile? So I'm showing a couple of different volume levels. Let me clean this up. And the first is
he's saying the actual chart near the market buy bubbles.
Okay, I'm not quite sure. So there are a couple of volume indicators, and this is volume is shown here, and this is also in terms of delta. And the reason these are so small is because of this bar right here. And this is pretty typical of stocks, especially, and ETFs, is the large volume right at the open and at the close. And this is the RTH close right here. See this big green dot and this big green bar, and volume is so great compared to everything else that what Bookmap does is shows that it's showing compared to volume. So that bar is so big and that dot is so big that it makes everything small. But this is normally during the day, if I had zoomed to the left and that bar was not shown, then these volume bars would be bigger. I hope that answers the question. And then the size of the dot also indicates volume. And again, that is market buy minus market sell. The green and pink and red and blue numbers near the dots. Okay, so what that is the absorption and sweep indicators, and that's an indicator included with Bookmap. So what that is showing is absorption is passive or passive orders. So those are resting, that's resting liquidity that is absorbing typically aggressive market and buy orders. So the passive orders are shown by this kind of light blue number and pink. And then the sweeps or the aggressive orders are shown with red. So this red number here would indicate aggressive sellers, and the green number indicates aggressive buyers. So that's the sweeps indicator, and then the pink and the light blue, those are passive. Okay, so that was the setup for today, for that day, and this is again August 15th. And remember again, my thesis was looking for a bullish entry, so I was waiting and assuming that the 330 absolute gamma strike would act as support, and it did, and waiting for this trend break, and then, well, then a bullish entry just above the trend break at first number 3. Okay, and now let's take a look. And this is how this is the total day, and I was showing most of the total day before. So remember, I was talking about the chop for the first couple of hours. So chop, and the key gamma strike or the absolute gamma strike held. Trend break, and then the move higher. So that's how the day played out. And again, it did play out as expected, lower volatility with a bullish bias. And let's look at some alternative trade ideas. And there were a number of ways to take the trade, and probably the easiest way was just to buy a call, and assume that if you watching this for a while, seeing the key gamma strike or the absolute gamma strike hold a support, just buy a call and go about your day, or wait for that trend break and a more precise entry, buying QQQ shares if that's how you want to approach it, or it's just selling a put or buying a long call spread, and that would minimize your time decay, time risk, and also a short put spread instead of a short put, and that would lower your margin and your risk. And again, what I'm kind of leaning toward now is just trading with options instead of shares, and that's just because of my busy schedule. So here's the key takeaways from this case study. First of all, the rising absolute gamma strike, call wall, and CP gamma tilt were all bullish signs, and that led to a directional bias in my planning. And again, so I was looking for a bullish entry and watching the reversal higher at the 330 absolute gamma strike. And that strike and that trend break that I talked about was the entry for bullish trades. And then finally, my expectations for volatility were low. So I was not looking for, 10-point move, just looking for a lower volatility, a smaller move. And that was indicated by the positive gamma notional and the neutral Vanna model. So again, that set expectations for lower volatility. Any more questions, or Brent, do you have anything, any thoughts, comments?
Yeah, I think that, again, back to the levels, the key point here being that shift of that absolute gamma level. We've actually found that in the equity market, when the market or when stocks go below their key gamma strike, they tend to mean revert. There's a stat we have that we're zooming in on around that idea. So that shift of that strike is actually very important. And I also like the fact that you're very clear about setting up the thesis at the start of the day, and then you look for a trade setup that kind of plays into that thesis. I think a lot of times we sort of like look at how the market starts to trade and then try to apply a thesis afterwards. But this really shows the way that you set up your day. You have a thesis and you wait for a trade that will help you to express that thesis, as opposed to trying to kind of build the thesis after the fact. So I think that's really quite helpful. And then the other thing is letting the trade run to the different levels is also one, I think, that can be a little bit of a challenge. I've talked to a lot of other people who use the SpotGamma levels for futures trading and the like, and the idea is that, look, we're going to buy at this level, and then we're going to let it run until we kind of hit this next major options level, or sell, vice versa. So I think those two takeaways from me are something that I've seen before, and the people who have really consistent processes seem to do that very well. Yep, Pool asked for the thesis page, so there you go again. And Mark, you're more than welcome. I'm glad that this was very, very detailed. Doug does just an amazing job at tracking these trades and laying the whole thing out.
Now, one more thing about my thesis, I always confirm my thesis. Mm-hmm. So I have a thesis, and usually it works out. This information that SpotGamma provides is very helpful. And sometimes it doesn't, but I always confirm my thesis with price action, order flow, and again, it usually works out. Sometimes it doesn't, mm-hmm. But I think it helps. It's very helpful to come into the day with a framework, a thesis for the day that you have confidence in.
Yeah, I completely and totally agree on that. And again, and in letting that thesis work is the other, I think, really key thing here that I take away from your presentations. Oftentimes you get a trade that's kind of working in your favor, and then maybe you cut it a little too early, or you don't let it work to the next major level. So as we kind of watch the market right now, we have that kind of interesting setup, right, where we're breaking below 3,900 and implied volatility is rising, and that should, based on the models, mean that we kind of test the 3850 or 60 area, and oftentimes it can be very hard to, I think, let those trades or those expressions work. But again, it's just, when the setups are there, you got to kind of trust in that process. So this is very helpful to lay that out for everybody. We have any other questions out there? Please feel free to pop them in the Q&A or the chat, and Doug and I are happy to track or adjust those questions. Doug, do you have a particular setup that you're looking at today that you want to talk about, or haven't really had a chance to kind of dig in yet this morning?
Today, well, S&P 500 is definitely bearish, and I noticed that for SPY, the put wall and the key gamma strike or the absolute gamma strike both dropped. And I interpret that as bearish. So the put wall dropped from 395 to 390, and then the absolute gamma strike dropped from 400 to 390. So, taking that, just, that information, looking at that as bearish, and then as you mentioned, the 3,900 support level, SPX 3,900 support level did not hold, and that's bearish as well. And beyond that, I would have to take a look and see what options traders are doing for today. But I would definitely be was looking and would have looked for bearish entries today. There seemed to be a tone shift yesterday when the 400 call wall did not hold, and there was such a I thought kind of a large unexpected drop. I was not expecting a drop of that magnitude yesterday. Yeah. But like I said, the trade of the day was just to buy a SPY put at that level and just hold it. There was never any reason to exit that trade until the end of the day. If you bought a 0 DTE option, of course you want to get out at the end of the day, and there was never a reason to get out of that. The put wall, as I recall yesterday, did not offer much support. So
yeah, the spider put wall was 395 and the SPX was 3,900, and that 395 area was just kind of below that vol trigger level, and yeah, once we broke there was a very meager bounce attempt. But that was so interesting to me, is that implied vol just kept pressing higher all day. And that's kind of a similar situation here, where the VIX just continues to kind of rise higher and higher. It's not exploding higher, but what you look for is implied volatility, and you just watch the VIX. You look for that to start to come down as a signal that people want to start selling those puts. But clearly it feels like something broke. I mean, I was just flipping through some charts, just looking at the price action, and there were so many charts that were being posted, 2 days ago, that were breakout charts, right? Like, look at this candle, like rising wedge breakout, right? And all these different stocks, and those charts all look like they've just been obliterated today. It's really pretty fascinating. So I think a lot of very sneaky damage was done. I think a lot of narratives got broken yesterday, in terms of maybe kind of a Goldilocks move higher, but very kind of curious market action. Al says, if put walls are in negative gamma territory, why are they considered walls rather than downside vacuums? It's a great question, Al. Our view there is, with the put walls, what we believe to happen is that because gamma is highest for at the money options, we think that when the market trades down in those put walls, that puts tend to get closed and or rolled to lower strikes. And so the thesis there is that if you see the market hit the put wall and you see volatility start to come down, implied vol start to come down, that's a signal that traders are selling an at the money put, right, which has a lot of delta to it, and then they're rolling it out to some other smaller weighted put position, and that can help to provide a market bounce. Incidentally, one of our stronger stats that we have on our blog post, we have something called the options walls. If you look that up, one of our strongest stats is if the put wall rolls higher, that has like a 60% odds that the market actually goes up the next day. So that's a very strong indication, and again, that's detailed on the blog if you want to check that out. But the idea is that it is a vacuum into the put wall, and then ideally you see signs that positions are being closed, and again, if puts are closed, then you would expect the put wall to raise up to a higher strike if the following day. So that's the general thesis around that.
And there's a question, what am I expecting from the current liquidity at 3,900? And I don't know, Britt, I don't know if you want me to answer that. I can.
Yeah, sure. If you feel comfortable, that is.
So I will tell you, first of all, that I I do a live stream daily for Bookmap at 1:30 p.m. Eastern time, and that is at least half SpotGamma. So I'd say half and half, SpotGamma and Bookmap, and that's at 1:30 p.m. Eastern time, either in Bookmap Discord or on YouTube, the Bookmap YouTube channel, and that's at 1:30 p.m. Eastern time. And I will certainly talk about that today, but we can look at Bookmap today. And what I'm showing here is I have two columns of levels. This is the SpotGamma Cloud Notes, and this is included with your SpotGamma subscription for your whatever platform. There are a number of platforms, and this is for Bookmap, and these are updated automatically. So there's the 3,900 put wall, and it did not act as support today. It looked like it actually more acted, closer to resistance. So I'm looking at the next level down. Let's just scroll down. So there's the ES 3,900. There's the next support level, and that is the SPX 3860. And that was noted in the AM Founders Note. And then there is the SPX 3850 right here. So it seems to be kind of a no man's land down below 3,900 with not a lot of significant support. So just looking at order flow, it looks like large traders with their iceberg orders, and they use iceberg orders to hide their size. That's positive. So large traders are buying this dip. And then there have been, this yellow line shows that stop orders. There have been sell stop orders. That's the yellow line. And then cumulative volume delta is negative. And so beyond that, I would have to look at Hero and see what options traders are doing. And they often, in the S&P 500, tend to fade these moves. So I would expect that, if not right now, at some point, that traders would start selling puts, especially with a higher volatility, and potentially buying calls as well.
Yeah, that was certainly my expectation too, Doug, in terms of the vol selling, and we're just not getting that rollover yet. But I do think if we start to see the VIX, as the signal break down, then that'll be the sign that maybe there's some dip buying in effect. So we'll have to keep a close eye on that. All right, so we are rounding up to the top of the hour, which means that we should probably move to close the session. As Doug, I know you got another webinar at 1:30, and then I have the subscriber Q&A today at 1 o'clock. So all of you, I hope to see you there for me at 1 o'clock. If you want to join the Bookmap discussion, I'm not sure, Doug, how people can get on that, but the Q&A, there's an email that just went out.
The easy way is the Bookmap YouTube channel.
There you go.
That's at 1:30. So after the Q&A, you'll join a little bit late, but I stream from 1:30 to 2:30. And again, my content is at least half SpotGamma. So half SpotGamma, half Bookmap, and I go through my positional analysis every day, and then I show trade setups. So it's kind of like a mini boot camp.
Yeah, that's awesome. So I've seen some of those presentations before. Hopefully I didn't lose you there, and they are excellent. So again, thank you everyone for joining today. We appreciate it. Thank you all again for joining today instead of yesterday with those technical difficulties. And again, I hope to see you in about an hour on our Zoom channel. Look in your email for that link. We'll also put that in the Discord chat, and then please hop onto the YouTube channel after that and join Doug for his bookmap presentation. So Doug, most importantly as well, thank you for taking the time to present for everybody today. I think it was very informative, and we will have the recording available for everybody on SpotGamma.com.
All right, glad to do it. Thank you very much, Brent, and thank you for your questions and comments, everyone, and thanks for watching.
Take care.